Welcome, everybody. I hope you are doing well. This is the intro portion for episode number 1822 with Jeff Snyder. Now, if you're watching on YouTube live, we already played the Jeff Snyder episode on YouTube and had such great feedback, but did not play it on the podcast yet. So it will air tomorrow on the podcast. And I tell you, if you want to know about the secret economy that runs the world. No, it is not the United States. It is not China. It is this sort of secret economy that you're going to learn all about today with Jeff Snyder. So we will have that in a few minutes. But before we get to that, I just want to talk to you about a few things. There is obviously so much going on in the world. We are living in, as the Chinese say, may you live in interesting times, right? And we are certainly living in interesting times. This war is absolutely tragic, and the results of it are going to be felt for a decade. Yes, a decade, if not longer. Let's assume it resolves itself somewhat quickly, right? That's the best hope we can have, that it'll resolve somehow, some way, somewhat quickly. And if it does that, the results of this will be with us for a long time, probably a decade. We will still be talking about the results of this incredible package of sanctions on Russia in 2032. I mean, it is just unbelievable. The ripple effects from this type of thing are absolutely amazing and potentially catastrophic. So let's talk about the real estate market more specifically and how it impacts that. Well, nothing could be better than this graphic: a house underwater, right? And everybody is thinking about this. Is the market going to crash? Are we in a bubble? And that is the trillion-dollar question. It really is the trillion-dollar question. And I have an answer to that. I'm going to attempt to answer that for you right now, actually. The answer is yes, the market is going to crash. But the question is when. If you listen to the prophets of doom, who really, I don't know, I don't go back further than this too much. Well, I guess there was Malthus, and there have always been prophets of doom. Hey, there was Chicken Little, right? Remember Chicken Little? Chicken Little was an economist too, right? The sky is falling. So there have always been prophets of doom, people always predicting the end of everything, right? It's nothing new. But in modern history, we certainly had Peter Schiff. He's been on the show before, and he's always out predicting doom and gloom in one way or another. We have Doomberg. They were just on the show. We have Harry Dent. He's been on the show like a dozen times now. He was on just again recently, sort of the same kind of spiel, right? And these people will all be right at some point. The problem is, if you listen to them and if you put too much stock in it, you could miss the run-up to the crash, which will inevitably come. There's always going to be a correction. Folks, of course, there are always cycles. The Austrian School of Economics, the business cycle, yada, 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 right? Of course, we're going to have cycles. Of course, we're going to have corrections. But when I see these idiots out there, I was watching a guy on YouTube today who will remain nameless until we get him on the show, and then I'll debate with him. Haven't interviewed this guy yet. But he's talking about how housing markets, way back into like the 40s, right? And beyond, how housing markets always boomed after income increased, right? And then they always had a bust. And then he compared how much income it takes today to buy a house. And of course, I've done this for you in the Hartman Comparison Index. The HCI does this. It takes, how many years do you need to work at the median income to buy a house? Well, that number is higher than it used to be. But so what? Who cares? Who cares? Who cares? Because people don't buy on the price, they buy on the payment. And there are so many false comparisons. These people, I don't know if it's just lazy leaps in logic, or If they really believe what they're saying, I don't know. But look, I'll tell you one thing, folks. You've got to remember this rule of life. This is always the rule of life in the news media business. Now, in the old days, it was traditional media, it was the newspapers, it was television, radio, etc. Today, it's on the internet, it's YouTube, it's podcast, right? And that's great. So you get a lot more variety of opinion, which is awesome. But guess what? Everybody is competing for clicks. So what do we have? We have clickbait, right? Clickbait. And guess what gets the clicks? The doom and gloom, the bad news, right? I, for one, wish we would see a market correction. I hate this market. It's too crazy. It's too hard to operate. I've told you that before. They always talk about like there's a buyer's market and there's a seller's market, right? And now we're obviously in a seller's market. We've been in a seller's market for many, many years, almost consistently since we've sort of come out of the Great Recession. So it's really, to some degree or another, been a seller's market for about a good 8 years. You could even argue 10 years, a decade of a seller's market almost, right? But there's a seller's market and a buyer's market. And then there's a broker's market. Well, guess what? My company acts as an intermediary. We don't like this market. People say, oh, Jason, you're just talking your book. You're just talking now. Real estate's going to keep going up because you're making money off this. Yeah, but guess what? You can't hear the dogs that don't bark. I'd be making way more money if the market would cool off a little bit and we had some more inventory, right? A more even keel, stable, balanced market is a better market for us. You talk to anybody in the real estate business, in traditional real estate, not like what I do, and they'll say the same thing. They'll say, all of my realtor friends say the exact same thing. It's just so hard to operate in a crazy market like this. So that said, let's go over some markets. And look, we've seen interest rates spike. So the question is, are we cooling off? Are we seeing the signs of cooling off? So let's look at some data here, right? So in my predictions, by the way, before we really dive into this, oh, wait, I got to share my screen. So here is the screen. So in my predictions talk, which hopefully you've seen, if you haven't seen that yet, I updated it. I update it all the time. In that talk, I talked about the level of inventory. And I said, just to get to a normal housing market, we need to see housing inventory increase by 300 to 500%. Yeah. Just sit with that for a moment. 300 to 500% increase in inventory just to get to a normal market. That's not a bad market or a buyer's market. It's a normal market. It's a stable, a balanced market, a market of equilibrium. So we're quite a ways from that. If you want to watch the indicator of the market turning, look for big swings in inventory. If you see big increases of inventory, something's going on. Something's going on if you see that. But guess what? We started off this year with the lowest inventory in recorded history ever since they've been keeping track of this stuff. Now you can ask me, well, when did they start keeping track of it, Jason? Well, roughly the 60s and early 70s, okay, is when they really got kind of good at that. Most of these stats, that's when they sort of got good at this stuff. In the late 60s, early 70s, they started really tracking things much better. So we started off with the lowest inventory. And everybody said, well, when rates go up, the market's going to cool off. Inventory is going to increase. The market's going to turn. Well, guess what? FOMO. Of course, you know what FOMO means. Fear of missing out. Guess what the rate spike did? And it's always done this. I could have told you this back in the 90s, in the early 90s. I remember having a conversation with a developer client of mine who worked for California Pacific Homes. They're a big home builder affiliated with the Irvine Company, one of the biggest landowners in the country, Donald Brent, right? And he and I were having this conversation about how when interest rates increase, a whole group of buyers gets off the fence and they make decisions for fear of missing out. Now, we didn't use that word because FOMO wasn't a thing back then. Nobody said FOMO back then, but they say it now. So fear of missing out, the desire to mitigate losses is a very powerful motivator, more motivating than the desire for gain. And so guess what? Everybody has just jumped into the housing market. They're going crazy. It's hotter than ever. The inventory is now lower than ever, lower than it was even at the beginning of the year, by about 51,000 fewer homes on the market now. So if you thought it was bad at the end of last year, at the beginning of this year, it's actually worse now. So there you go. Now, these people with this idiotic linear thinking, I got to call them out for a second. Folks, don't let this be you. Don't think like this. All of these people out there, all of these people make these blanket crazy statements. They say, well, if interest rates go up, people will be stretched to the end and they won't be able to afford anything. Okay. What the fuck does that mean? Hey, did I catch your attention using the F word? I meant to, right? Okay. So what the F does that mean, right? What it means is incomprehensible. It doesn't make any sense. That statement is a non sequitur. It makes no sense. Non sequitur. That's the right word for it. It's an oxymoron. Okay. It's not that they won't be able to afford a house, whatever that means. It means that they will have to adjust their expectations downward and get less house. On a future episode or live stream, I'm going to show you something I showed to our collective members. The collective mastermind is the mastermind I run with George Gammon and Ken McElroy. And we do these quarterly events and we do monthly Zoom meetings, each of us. So one time a month, George Gammon does a Zoom meeting with the members, small group, really intimate, get a lot of questions answered. Once a month, Ken McElroy, the Rich Dad author with Robert Kiyosaki, of course, he does one of the Zoom meetings. And then I do one of the Zoom meetings once a month. Well, last week was my Zoom meeting, so I did it. And I shared this example. I'm going to share it with all of you too. And it was about someone moving from a low-priced real estate city where they get a lot of home for their money to a high-priced real estate city where they get almost nothing for their money. Same price house, but the money spends a lot better in one market versus another market. Well, that's exactly what happens when interest rates go up, housing prices go up, housing affordability declines. What happens is people adjust their standard of living downward. The standard of living declines. These linear blanket oxymoron statements of when rates go up, who's going to be able to afford a house? That just doesn't make any sense. Like, I don't know what that means. What does it mean? It doesn't mean anything. Okay. All it means is they're going to afford less of a house. That's it. Or maybe they're just going to keep renting. And that's going to push upward pressure on rental prices, right? So there's all these factors. And the thing we've got to all realize is that everybody's competing for clicks and eyeballs with sensationalism. The old saying in the old media business was, if it bleeds, it leads. If it bleeds, it leads. So the gory tragedy, that's what sells the newspapers. That's what sells the 6 o'clock news, right? That's it. That's the game. Don't be fooled by this. There's much more nuance to it than clickbait. Okay, so now let's get to the visual aid I want to show you here. Okay, so this is Los Angeles, California, and it's a metric on the real estate market in Los Angeles, California. Now, I grew up in Los Angeles, so I know it quite well because I spent almost all of my youth in Los Angeles growing up there. And what we see here is just an overall kind of this speedometer that you're looking at on the screen shows that it is definitely a seller's market in Los Angeles. But the question is, compared to what, right? That's the Jason Hartman question. Compared to what? And guess what? Compared to a few months ago when I looked at this, it is less of a seller's market than it used to be. So the cyclical markets like LA, my hometown, they went more crazy. And now with the interest rate hikes, because they're so unaffordable already, I think this trend may continue. I think it probably will, actually. I'll make a predict. I'll go out on a limb and say that that trend's going to continue. These markets are going to cool more than other markets. Now, I used to always say, of course, you've heard me talk about this for the last 18 years, right? Linear markets, cyclical markets, and hybrid markets. LA is a cyclical market. Most of the markets we've recommended to our investors, as I've been doing this for 18 years, are linear markets. But nowadays, in this money printing orgy that the Federal Reserve has created, right? Almost every market is now a hybrid market. Okay. There's like almost no such thing as a linear market anymore. But historically, they'll level off at some point and there will be linear markets again. A lot of them will be the same places. So let me show you one market that used to be a linear market. Now I'd certainly call it hybrid, if not cyclical. And many of our clients have bought in and around this market I'm about to show you. But what's interesting about it is that when I looked at these same metrics a few months ago, before rates went up, now the Fed was rattling the saber saying they were going to tighten, rates were going to go up, right? This was different. Now it's changed. So watch this. This is Sarasota, Florida, a great city. I've purchased several properties there. Our clients have purchased several properties there. It's on the expensive side for sure as a rental market. Okay. If you want lower price rental properties, we have them. You're not going to find them in Sarasota, but it's pretty expensive. But, at different stages of our wealth creation game, we optimize for different things, which, oh, by the way, that reminds me. At the bottom of the screen, you see a little thing scrolling along there that says, get your tickets for Jason Hartman University, JHU, we call this. It is a virtual event live this week. Okay. It's Friday night and Saturday, well, depending on your time zone, but Eastern time, Saturday from 11 to 4. And these are great virtual events. I'm hosting it. I'll have some guest speakers. We'll be talking about some properties you can buy that we vetted. We'll look at performas. But one of the exercises we're going to have people do now, this is the first time I've ever done this event virtually. We've always done it live before. We've done it live across the country from San Diego, California to Orlando, Florida, and many other places. And so one of the things we do is we do this fantastic interactive game where it is a portfolio builder and optimizer game. And what I do is I give people actual properties that they can buy, and they have to optimize the portfolio. They have to choose between a group of properties and optimize which ones they want to buy depending on certain optimization vectors. So Sarasota and yours truly, right? So I did a bunch of 1031 exchanges last year. 1031 tax deferred exchange is a godsend for real estate investors. Remember, income property is the most tax favored asset class in America, bar none, full stop, nothing beats it. It's fantastic. And remember, it's a big deal because taxes are the single largest expense in any of our lives. So if we can optimize our portfolio for tax savings, that's good. If we can optimize it for the highest cash flow, that's good too. If we optimize it for the highest capital appreciation opportunity, that's good too. How about if we want to optimize for management efficiency? Well, that's really good too. So how do we pick? Right? There are different choices we have to make when building a real estate portfolio, depending on what optimization vectors we want to achieve. And that's a personal choice for everybody. Now, look, I've made a small fortune in real estate. It's been very, very good to me. I absolutely love it. I bought my first rental property at the ripe old age of 20 years old. And now that I'm 29, Joking, by the way. I don't want to misrepresent anything. That's a joke. I've just done super well with income property. I love it, love it. And many of our clients have done way better than me. Okay. But here's the thing, you optimize for different things at different stages. So last year I did several 1031 tax deferred exchanges. I sold a whole bunch of my properties and I moved the chess pieces around on the board. And so I bought some more expensive rental properties in Sarasota, Florida. That's kind of an expensive market. It's not for everybody. But, several of our clients did the same thing. But here's what I want you to see. This was the point. I know. Tangent alert, tangent alert. I always go off on tangents. And I was going to stop doing it, but all of you listeners said you really liked my tangents. So here I am still doing the tangents. So this is a tangent alert again, right? Back to the stuff at hand here, right? So look at Sarasota. Huge seller's market. This speedometer needle is way higher than my hometown of Los Angeles. It's now down to like a 60, right? It's almost moving into the territory of not really being a seller's market anymore. But Sarasota, hot, hot, hot. You can't buy a house there, right? I just bought a couple properties in Scottsdale, Arizona. Oh my God, it's just like Sarasota. It's ridiculous. It's so impossible to buy a property there. Like buying a property in some of these markets is an achievement at any price. It's so ridiculous, right? It's just crazy. So I just wanted to share that with you. I think this is the trend we will see with higher and higher interest rates. And I think this trend is going to continue. All right. So let's see. What else do we have here? What else do we have? A couple little tidbits from the Wall Street Journal. And this is interesting because during the pandemic, L inserted on purpose, we had a lot of talk about New York City. And I've said for years that the place you want to be as an investor is housing, housing, housing. Housing has universal need and it can't be outsourced, right? You can ship all the manufacturing jobs offshore to China and India and Sri Lanka, right? Look on the label of your clothing, right? Where's it made? Vietnam, Sri Lanka, maybe China, not as much anymore, right? You can offshore all the manufacturing. That lessens the need for industrial properties here in the US. You can outsource a lot of office workers, call centers, software development, et cetera, a lot of management consulting, legal work. If you hire a big law firm, guess what? Your big law firm is having a lot of people in India do their work, India and the Philippines, both. Yeah, I know. They're billing you like some ungodly $500 an hour, and they're paying someone $12 an hour, maybe for a high level person in India or the Philippines, right? It's absolute. It's a scam. Everything's a scam nowadays. Anyway, they can outsource office workers to the home. And that's where they've been outsourced the most during the pandemic, right? Working at home. So they lessen the need for office space. Obviously, the retail apocalypse has been going on. Thank you to Amazon, right? They've been destroying these small businesses. Really sad thing. And they basically outsourced retail property needs to the internet. Now, I know all of these sectors and categories still exist, of course. It's just that the demand has declined for them. And New York City office space availability rate in Manhattan as of February, 17.4% vacancy rate, the highest on record. That trend is going to continue and get worse, if you ask me. Construction jobs. I did a show on this recently, and forgive me because I can't remember the number, but it was a high number. We had an expert on from, one of these home builder associations. There are several of them. And he was talking about how the average construction worker now is like 50 years old. I mean, these are not like, this used to be a game where it was the young guys, 20-year-olds, 22-year-olds doing construction. Right? Now, the typical construction worker is like 50. And if you don't think this is true, I dare you to just go look around and notice it yourself. I mean, just notice, Don't look at a construction site. These are not young kids anymore, right? Building construction. So the shortage of construction workers is driving up the labor cost dramatically. 380,000 is the number of construction job openings as of January. And that's about 81,000 more than a year prior. Okay. So there's a huge shortage of construction workers. But wait, there's more. Now, why am I telling you this? Because it all impacts the price of housing. Therefore, that inflation is baked in the cake. And the question you should ask is, how much does it matter if interest rates go up? Because remember, I'm the one who's been talking to you about this for a long time, this thing that nobody has been talking about. I still know of nobody talking about this. Well, finally, Mike with Altos Research said it on his YouTube video last week, but nobody's been saying it since then. Only me. I'm alone, going out on a limb, totally alone saying this. What have I been saying? I've been saying that the tens of millions of people who have either refinanced their home or purchased a home over the past couple of years that we've had these insanely low, ridiculously low interest rates, they are going to beg, borrow, or steal not to ever give up those cheap mortgages. And therein lies the seed of a continuing housing shortage. They will remodel their houses. They will add a bedroom or add a family room. They'll take on roommates during bad times. They'll improve the house. They will do whatever they can not to let go of that mortgage, because as soon as they sell that property, they lose that fantastic, cheap, 3-decade-long fixed-rate mortgage. People are not going to want to lose these mortgages, folks. That is a big, big deal. It's a big deal. And it indicates to us that the housing shortage is going to continue for a long time. And the only real inventory that's going to come to market are those cases of people that get into really bad trouble with their properties. But I don't see much of that happening. I mean, the underwriting standards are like, what is your shoe size, your bra size, and give us a DNA sample. It's ridiculous. If anyone has done a mortgage loan lately, it's like cutting red tape lengthwise. It's absurd, right? They are underwriting these loans so carefully. This is not the Great Recession coming, okay? It's not going to be with a mortgage meltdown, at least we know that. And people are not going to want to give up these mortgages, okay? They're going to want to keep them because they're such a good bargain. You can't move them with the property. Okay. Here is the construction cost index. We talked about construction labor and the shortage there. Well, what about the materials? I mean, look at this. This graph is insane. It's almost like the fake graph that Al Gore presented in Inconvenient Lie, his movie on global warming. Okay, so anyway, just look at the cost of construction, how it is just skyrocketed. And it doesn't include the cost of the land, which has also skyrocketed. And what about the labor problem? They can't fill these jobs. I mean, look, I live in an area where they're building new homes. And this builder kind of sucks. They're slow and disorganized. I'm not impressed with him. I've been impressed by some builders. I tell you, the builders building properties on the Irvine Ranch, where I used to live in Newport Beach and Irvine, California, they're impressive. They know how to run a building company, okay? Those builders. This one, not so much. Not so much. Who's that says that? Borat? What a disgusting, vile guy Borat is. I mean, can you really watch those movies? I tried to watch the last one. It's just vile. I mean, we are witnessing the collapse of civilization. That's just what we're witnessing. Anyway, that's a tangent alert. Okay. So Yeah, the construction. So anyway, they have these houses and they just build them so slowly. And sometimes I would walk by the houses and they're under construction. There's nobody working there. They don't have any workers, or they don't have the parts they need to finish the house. Like, you can't finish the house if you don't have the cabinets or the faucets or the doorknobs or the hinges or the workers. They just don't even have the workers, right? It's absolutely crazy. I mean, this is a crazy time. And some of it, yes, Jerome Powell, I can hear you now. It's transitory. Yeah, some of it is a little bit transitory. I agree. It's not all going to last forever like that, of course, but it's not completely transitory either. Okay, there's a in between. Now, jobless claims. Look at this one, and I don't know why it says plus Apple may want to lease an iPhone. I don't know why that's there, but anyway, jobless claims fell to the lowest level since 1969. Wow. And by the way, do you know that we are closer to the summer of 2069 than we were to the summer of 1969? Remember the Bryan Adams song? That's a great song. The Summer of 69. It's an awesome song, by the way. Yes, before the cultural decline. Well, that was the start of it, actually. Woodstock in 1969 was the start of it. But hey, we also landed on the moon that year, and that was pretty impressive. Or maybe it was just a Hollywood set. Okay, I got to put on my hat now. What do you think of my new hat? Pretty cool, huh? Covers up my receding hairline. I'll take it. So we have a new thing. It's a new thing for you. And if you would like a strategy session, a free strategy session with me to talk about the highest and best use of your assets, are they in real estate? Are they in cryptocurrency? Are they in stocks, bonds, mutual funds? Whatever, wherever, precious metals, we can talk about all of that stuff. We can talk about real estate exclusively, whatever, right? But we are launching a fantastic coaching program. And if you would like a free strategy session, just go here and book it. Book your 15 minutes of fame with yours truly, your coach. Hey, I'm acting a little goofy tonight here. So that's jasonhartman.com/coach. And we will see you there. Anyway, that is, let me grab a couple of questions and comments here, folks. Let's see here. What do we have? We have Calvin says, to me, commodities are going up. And since a house is just a bundle of commodities, therefore they must also go up. Yes, Calvin, if you've been following my work, and I don't know if you have, I talk about packaged commodities investing. That's a trademark of mine from many years ago, also assembled commodities investing. And for the last 18 years, I've been talking about how you're really buying this package of commodities that is assembled on the construction site. What is it? Glass, steel, lumber, copper wire, petroleum products, energy, labor, concrete, all of these things, right? And commodities are the thing to own. In times of inflation, you want to minimize your ownership of currency and maximize your ownership of things, especially those things that have universal need. And what is a universal need? Well, we've all heard the saying, what do people need universally? They need food, clothing, and shelter. Yes, let them rent that shelter from you. Okay, so absolutely great point, Calvin. Thanks for mentioning that. And what else? Let's see here. Okay, it looks like you're flipping properties in Indianapolis. That's been a long-running market. I've been recommending Indianapolis for a very long time. Fantastic. I've owned many properties there myself. And but flipping as active income, yes, and you're going to pay a hefty tax bill for flipping. You know, look at what I've always said is that, and I've done a number of flips in my life and I've made money off them. Okay. So I'm not saying it's bad. I'm just saying this, that I've noticed over the years that the flippers have spending money and the buy and hold people have real wealth. So if you need to flip a house or two to get some capital to invest in a long-term buy and hold portfolio, do that. That's a good way to start. Okay. So be a flipper. and then turn that into a buy and hold portfolio, because that's how the real wealth is created long term. Okay. Okay, Robert says people need to be careful where they're buying and how much they pay for the property. Yes, well, as always, of course they do, but I'll just say, Robert, um, don't expect any bargains today. And I'll just give you some examples of my own examples, and every one of our clients will tell you the same thing, right? But just my own examples of some of these properties I bought last year, right? At the time, I felt like it was ridiculous. Seller's market, super low interest rates, multiple offers on every property. It's like there wasn't a property without multiple offers. And, I was really just angered, annoyed at the cockiness of these sellers. They're so cocky, I would say. Like, stop being so arrogant, right? That's toxic. But guess what? All of those properties I bought look like a great deal today in the rearview mirror, because guess what? I just refinanced 4 of them, and every one of them appraised for more than I paid just a few months earlier. Now, is that going to happen forever? No, of course not. It's going to change at some point. So don't be too careful on not being willing to pay the price that you don't get anything, okay? Because every deal looks great in the rearview mirror. Just give it enough time and the deal's going to look great. So, yeah. Okay, so I suggest, Mimo says, look up the milkshake theory. Yeah, we had Brent Johnson on the show. He's been on the show, and he talked about the milkshake theory in depth, and I agree with him, and I disagree with Peter Schiff. Although Peter Schiff is super smart, he's the master of the soundbite, he's got all these zingers, I love listening to him, but largely, he's just wrong a lot. I mean, look at, if you predict doom and gloom long enough, every 10 years, you're usually going to hit a recession or two. And then he's going to say, oh, I was right. I called that. Yeah, well, guess what? That broken clock on the wall is right twice a day too. Okay, so, take it for what it's worth, folks. All right. The milkshake theory, Brent Johnson, look that up. Check it out on my podcast, okay, and my YouTube channel. Okay, and says, yeah, preach, Jason. You're right on. Yes, thank you. Appreciate that. Okay. So do you think 40-year fixed rate mortgages will be the norm in the near future? Hey, guess what? You can get a 40-year mortgage today. And it's so great. I love this 40-year mortgage, except for one major thing. I'll tell you about that in a moment. Here's what I love about it, though. Let me tell you what I love. I love that 40-year mortgage is 10 years interest only in the beginning. And then in year 11, it starts amortizing over 30 years. Now, amortized means you're paying principal and interest each month. Amort is from the Latin word to kill. In other words, to kill the mortgage. You amortize it down by paying principal and interest rather than just interest only. But you get to pay interest only the first 10 years. That is awesome. That is my favorite loan ever. Look, inflation will pay down the mortgage for you. You don't need to pay it down yourself because you can use that capital to buy more properties, right? But here's the problem. As of today, that 40-year fixed rate mortgage is really expensive. Well, it's still cheaper than the rate of inflation, so it's not actually really expensive. It's just a lot more than a 30-year fixed rate mortgage, and that's the reason I don't totally love it. Okay. Ermine says, I need a whistle. Well, I don't have a whistle, but I do have sound effect machines. Look. Yeah, so, I don't have a whistle, but yeah. Okay, so let's look at some more questions here. Considering where fixed rate mortgage is, would it make sense to take a variable rate mortgage? Probably not. Now, I must tell you, I am considering a variable rate mortgage personally on a personal residence I just bought because of my life stage. I mean, look, a 30-year fixed rate mortgage is a great deal, but I'm probably not going to turn this property that's going to be about $2.5 million. Okay. I'm probably not going to turn that into a rental. So I'm probably not going to keep it after I want to move out of it. So, a 7-year fixed rate mortgage, given that I get a much lower rate, and this is for a personal residence, I kind of think that's okay. It just depends on your life stage and your situation. I would defer to your own personal situation to an extent on that. But on the rental properties, you're probably going to keep those for a while. So at least get fixed for 10 years, if not 30, ideally 30. Okay. All right. Okay. Okay. So TG says, what do you think of zero down buying? Buying on terms. Any further thoughts on the Ron LeGrand approach? Yeah, we just had Ron LeGrand on the show. So Ron LeGrand was on 3 episodes ago. So last week, you'll see him. He's on the YouTube channel. He's on the Creating Wealth podcast. And Ron is great. I love his stuff. And I would recommend his approach. But I'll tell you, in this market, it is finding deals like that where you can get the seller to agree to those terms is like a needle in a haystack. Here's what you're mostly going to be doing in this type of market when you're trying to find these nothing down deals. And also, it's going to really limit your choices where you may have to sacrifice a good price on the property or a good property in general just to get those terms. And that's why I would not be myopic and I would not just focus on that. But in this market, you're so unlikely to be able to source those deals that you're basically going to be doing this. Waiting. Okay, anyway, you get the idea. And as you keep waiting, return on investment is going to pass you by. Okay. Steve says, Jason, I think, do you ever think the interest rate will go back down to 3%? If it does, when? Thanks. Love your work. Okay. So, look, interest rates are super hard to predict, but I just had a really interesting economist on the show, and I recorded that interview on Friday, and we'll probably publish that one next week. Okay. And he predicts interest rates. So you can listen to what he says. Because he has a lot of data, a lot of charts about it. It's also going to be on the YouTube channel as well as the Creating Wealth podcast. But that is unlikely unless, and let's just hope and pray that this does not happen. That is unlikely unless the situation going on in Ukraine turns into a broader world war. At that point, we probably would see a lot of pressure to cut rates, to stimulate. But look, the Fed has got this dual mandate, and that's the problem. There's this thing economists will talk about. You can look it up. I've done whole shows on it before. It's called the Phillips Curve. And the Phillips Curve is basically the trade-off between the unemployment rate and the inflation rate. And the unemployment rate is really just kind of a proxy for how hot or cool is the economy. When the economy is booming like it is now, and look, I want to make the broad disclaimer on everything. When I say the economy is booming, I'm saying that in the kind of the conventional way. What do I mean by that? The way that, any just run-of-the-mill academic news media person or economist is going to say the economy is booming. But what that doesn't say, that I want you to know, is my disclaimer. The backdrop of the booming economy is that it's built on a complete house of cards. The economy is an illusion, okay? We do not live in a real world, in a real economy. Like have you heard these things about, are we living in a simulation, right? It's kind of like that, right? The whole thing's a big scam propped up by fiat money and central planners, and the whole thing's fake, okay? But that said, inside of the fake economy or the simulation or the video game, right, it's booming. Right? So unemployment is extremely low. There's a huge shortage of workers. People have got to have some babies. I mean, the Western world is going extinct. Japan's going extinct. Russia's going extinct. In fact, one of the reasons Putin, if he, wanted to do his terrible things and, start a war, he kind of had to do it now. I mean, think about it from his perspective, right? We'll be a little geopolitical, and this is a tangent alert. But Putin has this dying country. I mean, Russia is a dying country, just like Japan and Western Europe. You got to have 2.1 kids, ladies. If you're not having 2.1 kids, guess what? You're going extinct. Okay? And extinction is forever. The birth rate is below replacement if you don't have 2.1 kids each, right? So, that if Putin didn't start this war now, I mean, he wouldn't have any soldiers. In 5 years, the demographics of Russia are so dire and so bad that there's just no soldiers. I mean, it's scary to think that many countries literally will not exist in a matter of a few decades. And by the way, if you think China is this big rising power, think again. China's got a 10-year runway, and then all bets are off because their one-child policy has created a giant demographic problem for them. So, yeah, it's an issue. So where was I with that? Worker shortage, interest rates. Yeah, so the interest rate thing, not likely to see the low rates again unless there is some major event like World War III. Let's hope that doesn't happen. Or some other, maybe they'll invent a new virus or something. Who knows, right? So unlikely. Because they've got to tame inflation, and inflation is dramatically higher. It's about double what they're telling us. Okay. And you all know that to be true. And by the way, food inflation is going to get a lot worse. We've talked about this before. Folks, everybody should be a prepper. Everybody has got to be a prepper today. Now, I don't mean make it your life. I host another podcast that I've hosted for many years called The Holistic Survival Show. And I've interviewed preppers, and I think it's kind of a sickness. Like just logical, rational prepping, do it and be done. You don't make it your life. It doesn't need to be your whole life, right? Prepping is not living, okay? It's like something you take care of, like going to the bathroom or sleeping, right? Just take care of being a little prepared, have some extra food, have some supplies, right? I've talked about this before on the show, so I won't go into it now, but everybody needs to be a prepper nowadays, okay? It's just being responsible is what it is. Okay, Jerry, what is recommended portfolio balance of real estate and mutual funds? 70% real estate, 30% S&P 500. Well, I certainly wouldn't recommend mutual funds at all, ever. Mutual funds suck. But an S&P 500 index, look, if you're going to be in stocks, I think that's probably a pretty good bet. But here's the problem. The example Jerry gives is problematic, and here's why. 70% real estate, 30% S&P 500 index fund. Why is that problematic? Because what we don't know, like the way most people will think of that is, okay, I own, let's make it this number for round figures. I own $700,000 of real estate and $300,000 in an S&P 500 index fund. Okay. Well, does that mean you have 70-30? Is the 700,000 in real estate all owned free and clear with cash? I hope to hell not, because you want to get the inflation-induced debt destruction. My trademark term, if you don't know what I'm talking about, look it up. Very important strategy, inflation-induced debt destruction. Go to jasonhartman.com, find out more about it. You can type in the little search engine there, any of the podcast episodes we've done or on the YouTube channel. But, you probably only have maybe $200,000 in equity in the $700,000 real estate portfolio. So do you have 70-30, right? I'd say get 70. I mean, if you're going to have 70% of your cash in real estate, you can probably own a lot of real estate. So it's not 70-30 on the overall price, because real estate has the beauty of being smartly leveraged, that you have to really consider, what do you mean by 70-30? Anyway, you get the point, right? Okay. Could you explain a bit about what your coaching service will include? Will it be a focus on specific strategies or anything under the sun? Okay, so thank you for asking that, by the way. So that's why book a strategy session with me. Okay, but basically we have 2 coaching programs. One is the general coaching program about building a fantastic income property portfolio. Okay, so it goes over everything, all aspects, everything. The other program we have is dedicated to a focus on optimizing management. So that could be self-managing your properties and getting rid of your property manager who's got their hand in the cookie jar all the time, right? And being independent. That's where the power is in life, in being independent of your property manager and self-managing your properties. I tell you, it's the way to go. You can do it remotely. It's really quite easy. I've done it for a long time, many times myself. Many of our clients have. They love it. It's great. So helping you self-manage, and that's really a done with you program where, time permitting, on the coaching sessions, I will literally get on the phone with you and call the people that need to be called, helping you screen tenants, helping you advertise your property, helping you fire your property manager. Boy, that's going to feel good when you do that. All of that stuff, right? So the management optimization and then just general income property investing, 2 different programs. And either of those can be enhanced with individual one-on-one coaching with me. So kind of 2.5 options there for you. Hope that makes sense. And book a strategy session. And that is right there at jasonhartman.com/coach. jasonhartman.com/coach. You can book a strategy session. And you know what? If you're not ready for that, just join us next week, Friday and Saturday, for our virtual event, and get your tickets right on the front page of jasonhartman.com for that. Okay. So let's see what else we have here. Okay. Point of view of investors. Yeah. And I don't know which point of view you're referring to. So well said. I forgot I can put these on the screen. I haven't done enough live streams lately. Okay. So what do we got? Thank you. That is the truth. Yes, it is the truth. Okay. So true. Yeah, good. And George Gammon. Yes. And by the way, he'll be on his live stream soon. Got it. 9 houses leverage, 70-30. Okay, good. And Jerry, you want to keep them leveraged to the max. If you're not familiar with my refi till you die strategy, be sure to look that up, because that's a great strategy for extracting the wealth from your properties in a tax efficient manner, and also in asset protection efficient manner as well. Refi till you die. Another little trademark technique of mine. Okay, and you booked your session. Awesome. I look forward to it. Can't wait. And let's see, would love to see optimize the portfolio. And yes, fire your property manager. Just if you do nothing else when you join my coaching program, but fire your property manager, you got the coaching program for free right there. And and then some. You probably got it for free, and you'll make money in just 1 year, right there. Okay, so good. Okay, so Jason, I'm thinking to sell my property, has a mortgage now, cash flow is about $400 per month. And buy that equity property. Cash flow is about $1,200 per month. Well, of course, I would like to see better cash flow, but I would not like to see it at the expense, Barack, of free and clear. So, Barack, if you're thinking you're going to sell this property and you've got a bunch of equity in it, you're going to buy like a cheaper property and pay it off free and clear. I do not favor free and clear, my friend. You get no inflation-induced debt destruction. Paying off mortgages is not a good deal. I did a video on this a long time ago. There's only like a couple of little times when that might make sense. And even then, it's not the best optimization. You want to use the leverage. It's so cheap. You're getting paid to borrow the money. I mean, think about it. Even with these higher rates, they're still lower than the rate of inflation. So the higher rates, yeah, okay, you're paying, 4.75% even, right? Okay. But historically, number one, that's a very low rate. No, when I got into the business, when I was 19 years old and I got my real estate license, mortgage interest rates were 14%. And people thought that was a bargain because it was coming down from 19%. Okay, so just keep that perspective. Of course, houses were cheaper then too, right? But here's the thing. The official rate of inflation is higher than the 30-year fixed rate mortgage. That has only happened a few times in history. I showed that chart on another recent live stream, so you can find it on my other videos. And that chart is just, it's so telling. It's so mind-boggling. Keep your properties mortgaged. You're getting paid to borrow that money. You want to borrow that money. Okay. Okay. Jerry says, I live in California, but I own 9 in Georgia. Yeah, good, good. So Georgia's a good market. We've done a lot of business in Georgia. I own the management company. I pay people for certain. Okay. Okay. So if you own the management company, then in essence, you're self-managing, I guess. I mean, I don't know your exact scenario, but in essence, it sounds like you're self-managing. So good for you. That's great. And Barack says, thank you. My pleasure, sir. And, if you need to talk to any of our investment counselors, just reach out through jasonhartman.com. Any of them will be glad to set up a free consultation with you and help you out with anything. Okay. And yes, Mimo says, listen to him. Don't pay it off. Yes. Do not pay your mortgage off. So before I go, ladies and gentlemen, I want you to raise your right hand and repeat after me and say, I love debt. I love debt. No, you only love good debt. And mortgage debt, good, cheap, long-term, 30-year fixed rate mortgage debt is investment grade debt. That's the good debt. Even a good car loan on a reasonable car that's not where you're busting the budget, just a reasonable car that, fulfills your need, that's commensurate with your level of wealth. Okay. Even a car loan is a pretty good deal. I mean, they're super cheap. They're not adjustable. You can use that cash, rather than paying off a car with $50,000. Why don't you use that $50,000 and buy a rental property and leverage the car? That's, the car loan is actually not that bad a deal. Yeah. But credit card loans, absolutely not. Student loan debt, total scam. We've talked about that. And, RR says, I love debt. Yes, absolutely. And that's cool. So, okay. So do your providers have any properties coming up soon? Oh, yeah, we've got Jonathan, we've got some good properties in Alabama. So reach out to our team members, our investment counselors. We'll get you connected with some of our local market specialists there. Alabama is a great market. That's good. Shiznit. That's a cool expression. I like that. Okay, good. All right. Sounds good, people. I'm going to leave it at that for now. I've gone, of course, way longer than expected. And this was supposed to be the intro for our podcast tomorrow with Jeff Snyder. So we're going to play this and no Jeff Snyder, but we'll get him on the next episode after that. Anyway, thanks so much for your comments, for joining me. Really appreciate it. Oh, one more thing. I got to announce the winners of our raffle. Ashley sent them to me. I got them right here. Oh my gosh, I almost forgot. So every week we are giving out 2 Amazon gift cards. Yes, 2 Amazon gift cards for $50 each. Okay, 2 Amazon gift cards, $50 each. And we give 1 gift card out to someone randomly who made a comment on one of our YouTube videos. So we have a little software tool for this. Just make lots of comments on our YouTube videos. Yes, you're helping me because the algorithm likes comments. You could say meaningless things. It doesn't matter, I guess. And then we use the picker to just pick someone every week to win a $50 gift card from one of those YouTube comments. So last week's pick, let's see who it is here. That's the next one. Last week's pick was Armando Moran. Hey, we're friends on Facebook. So you're always commenting on my stuff. So his comment was, interesting explanation of the lease purchase strategy. He's probably referring to my interview with Ron LeGrand. And so good. So you won $50. Now to claim your prize, you got to go to jasonhartman.com/ask. You have 30 days from now. If you claim your prize in 31 days, you won't get it. So claim your prizes, folks. Claim your prizes. So 30 days to claim your prize. Now, the winner for the next way we give out a $50 gift card every week is to someone who wrote a review, and the review could be negative. You might not like me. Imagine that. How could you not like me? Anyway, the review could be whatever. Just write a review on Apple Podcast, formerly iTunes. And the winner this week is Rob S.A. It truncates the name, so I can't see your full name. But Rob says, Jason has the best questions and the best guests. Love the format of the show. 2 fresh episodes every week, a Flashback Friday episode to something timely of concern, because things reoccur in patterns, and every 10th episode, something of more general interest, helping inspire and fascinate even more. Really love the show. So Rob, thank you for the kind words, and you have won a $50 Amazon gift card. Go to jasonhartman.com/ask, and you can also go there just to ask a question, and we will answer it on the air. But you also go there to claim your prize. Same place, jasonhartman.com/ask. Thank you so much for joining me, and have a very good morning, evening, or day, wherever you are in the world watching this. Thanks so much, and happy investing, everybody.